Why should I invest? There are a few compelling reasons. Fight inflation by investing. One can deal better with the inevitable reality of life, the growing cost of living, generally referred to as inflation. Create wealth by investing. One can build a bigger corpus by the end of the target period. The target period was up to retirement, but it can be anything: children's education, marriage, house purchase, retirement holidays, a better life, to meet life's financial aspirations. Where to invest? Having figured out the reasons to invest, the next obvious question is, where would one invest, and what return can one expect with investing? When investing, one has to choose an asset class that suits the individual's risk and returns profile. For example, one individual will be open to taking a lot of risk with his or her money, while another may want to take moderate risk, while another would want zero risk. Think of an asset class as an investment vehicle defined by its risk and return characteristics. The following are some of the popular asset classes: fixed income instruments, equity, real estate, commodities, precious metals. Fixed income instruments. Fixed income instruments are investment avenues where your principal amount, the money you invest, is perceived to be safe. The entity pays an interest amount on the principal you invest. The bank's fixed deposit scheme is the simplest example of a fixed investment instrument. The interest paid could be quarterly, semi-annual, or annual. The capital is returned to the investor at the end of that investment period, also known as the maturity period. A few examples for fixed income instruments are banks' fixed deposits bonds, issued by the Government of India, also called JSEC bonds, and bills, bonds issued by government-related agencies such as JAIL, Hunto, Hay, Axe, bonds issued by corporates Tata, Bajaj, Reliance, Adani. A typical return from a fixed income instrument, banks, varies between 5–6%. Government bonds offer about 5.5%, and a few corporate bonds offer nearly 9 or 10%. The rates across different instruments vary because of the risk varies. The GOT bonds are considered the safest investment with zero risk to your investment because, well, the GOT can't cheat and run away with your money. Corporate bonds are risky, though. Investment in corporate bonds can go to zero, and we have seen plenty of such examples in the past. Equity. Investment in equities involves buying shares of publicly listed companies. The shares are traded on the Bombay Stock Exchange, BSE, and the National Stock Exchange, NSE. When an investor invests in equity, unlike a fixed income instrument, there is no capital guarantee. However, as a trade-off, the returns from equity investment can be much better. Indian equities have generated upwards of 12% CAGR, compound annual growth rate, over the past 10 to 15 years. Investing in some of the best and most well-run Indian companies has yielded over 20% CAGR in the long term. Identifying such investment opportunities requires skill, hard work, and patience. Real estate. Real estate investment involves transacting, buying and selling, commercial and non-commercial land. Typical examples include transacting in vacant plots, apartments, and commercial buildings. There are two income sources from real estate investments: rental income and capital appreciation of the investment amount. The rental yield typically varies between 2–3%, which is not so attractive, in my opinion. The appreciation in land prices is in select pockets and is not uniform. The transaction procedure can be quite complex, involving legal verification of documents. The cash outlay in real estate investment is usually quite large. There is no official metric to measure the returns generated by real estate. Hence, it would be hard to comment on this. Commodity, bullion, gold and silver are considered one of the most popular investment options. Gold and silver over the long term have appreciated. Investments in these metals have yielded a CAGR return of approximately 5–8% over the last 20 years. There are several ways to invest in gold and silver. One can invest in jewelry, exchange-traded funds, or sovereign gold bonds, popularly called as SUNS. Things to note before investing. Investing is an integral part of financial planning, but before you start your investment journey, it is good to be aware of the following. Risk and return go hand in hand. Higher the risk, the higher the return. The lower the risk, the lower the return. Investment in fixed income is a good option if you want to protect your principal amount. It is relatively less risky. However, you have the risk of losing money when you adjust the inflation return. Example, a fixed deposit that gives you 9% when the inflation is 10% means you lose a net of 1% per annum. Alternatively, the risk increases if you invest in a corporate fixed income instrument. Investment in equities is a great option. It is known to beat inflation over a long period. Historically, equity investment has generated returns close to 14–15%. However, equity investments can be risky. Real estate investment requires a significant outlay of cash and cannot be done with smaller amounts. Liquidity is another issue with real estate investment. You cannot buy or sell whenever you want. Gold and silver are relatively safer, but the historical return on such investment has not been very encouraging.